state and local taxes were reduced to $10,000. Mortgage interest was reduced to $750,000 home acquisition, and the mortgage rates were relatively low. So very few people had anything left to get them over a standard deduction. With a standard deduction now of about $31,000, it's possible that people will start itemizing again.
Welcome to the Mortgages Made Easy podcast. I'm trying something new today because of the fact that the great big beautiful bill passed on July 4th has a lot of implications for homeowners, for home buyers, for people in general, people who are investing in business. I've invited my good friend Mark Jurewicz to join us. He's a partner at Cullari Carrico. And he is an expert on taxation. Great guy. And we're also joined by Sonia Margolef. Sonia is one of the founding partners and a real estate advisor in the New Jersey side of Compass, one of the great real estate companies in the country right now. And so, Mark, let's start at the top. I'm a home buyer. What are the top provisions that I have to be concerned about with the great big beautiful bill? Let's start with the things that make my life better. So what's the number one thing for a homeowner that makes my life better?
Well, for most home buyers, it's mortgage interest, right? So the back in 2017, the mortgage acquisition debt limit was reduced from $1 million to $750,000 on an original purchase of a home. That 750 was a temporary reduction. That reduction now has been made permanent. So acquisition indebtedness is going to be limited. Interest on acquisition indebtedness is going to be limited to $750,000 of debt. So
that's essentially stayed the same. Is that not the case? Because it's been the case for the last 7 or 8 years.
It's been the case for the last 5-7 years, correct, since 2017. But again, that was temporary, but now we should all know that that's going to be permanent. That's a permanent reduction. Home equity loan interest has permanently been excluded from acquisition indebtedness. That was a temporary item as well. Doesn't mean that home equity loan interest is not deductible. We may find ways to deduct it, but it's not going to be part of home acquisition indebtedness anymore. Remember, we used to have $1 million of home equity interest, home acquisition indebtedness, and then you can tack on another $100,000 of home equity loan interest to get that $1.1 million. For most people, that's been eliminated. That was eliminated back in 2017, and now that's made permanent. Home equity loan interest is excluded.
Let's talk about that so I understand it better. I own a house. I have a $300,000 mortgage, say, and now I want to put an addition on, and I'm going to spend $100,000. Going to take a home equity line to pay for that $100,000 deduction. Is that $100,000 home equity line now deductible?
It's not deductible as acquisition indebtedness, but it may be deductible as mortgage interest if all that money went back into the home.
Okay.
Okay.
So you can't use it to pay your gambling debts. You can't use it to buy a car. But if I can identify $100,000 of home improvement expense, I can use the second mortgage to pay for the home improvement expense and then deduct that money.
Correct. Now, that piece, that home equity loan interest, was never deductible for alternative minimum tax, and it's still not deductible for alternative minimum tax. But for most of our individual taxpayers, the limitations for alternative minimum tax are the phase outs are extremely high.
Okay.
So most people are no longer subject to it. Alternative minimum tax still exists, but for most people, it's been eliminated.
Okay, so now I can deduct the interest payment on the acquisition debt, and I've obviously, let's say you acquired a home in 2025 and deducted, you paid 700, took a $750,000 mortgage, and now 6 months later you're going to refinance it because the rates are better. That acquisition debt remains deductible, even though it's now a refinance of an acquisition debt. As long as that's what you're doing, you can deduct it.
Correct. You have to be careful not to change too much in those terms, right? If you're refinancing to reduce the rate, you can't take more money out. Basically, it's you can't you can't um, refinance for $1 million, take that 250 out, and still call it acquisition indebtedness.
Right.
Acquisition
Right.
indebtedness is the cost
So
to
you
acquire the home.
can't increase the loan for, let's say you had 500, you can't increase it to 750 for kicks, but
Correct.
you can, if you owe 500 and let's say it costs you 20 to refinance, the 520 is going to be deductible, but anything additional won't. Do I have that right?
Correct. And
Okay.
the 1098 you get from the bank lists, the property. Again, acquisition debt is to be deductible, has to be secured by the property. That's, for instance, the home has to secure the debt. So you can't borrow on one property to purchase another and call it acquisition indebtedness. That's why the 1098 shows the property and the date the mortgage was taken out.
Okay. So now salt deduction. What is salt deduction and why should I care?
Okay, SALT is state and local taxes. And this has been an issue since the bill was signed back in 2017, the first bill, the first Trump Act. Uh, a lot of people didn't didn't recognize the fact that SALT was reduced to $10,000, but alternative minimum tax was also eliminated. In the old tax regime, when you had a large state and local tax, many people in New York, New Jersey, high tax states, uh, fell into an alternative minimum tax situation, which meant you didn't get your deduction for state and local taxes anyway. Uh, However, $10,000 in this part of the country is pretty ludicrous, right?
Mhm.
$10,000, you can get there very easily on real estate taxes alone, not
Hey,
dealing with it.
Sonia, what's the typical real estate tax on a house you're selling these days?
Um, Depends, of course, depends on the town and the county. I would say, and also if it's new construction versus it's an older home, so it's kind of like a difficult question to answer, but I would say we're seeing anything, in this area where we are in northern New Jersey. I'm going to say anywhere between um you know, I'm gonna say 12, 13,000 all the way to, I'm gonna say probably 30, 35,000 on average. Again, depending on the county, depending on the kind of, real estate that's being bought.
So when with the old tax bill, the standard deduction was increased significantly and deductions were limited. And the goal of that old tax bill was to reduce the number of people who were using itemized deduction method, right? Get most of the people into a standard deduction. It simplifies the tax code. Medical expenses already have a threshold. State and local taxes were reduced to $10,000. Mortgage interest was reduced to $750,000 home acquisition, and the mortgage rates were relatively low. So very few people had anything left to get them over a standard deduction. With a standard deduction now of about $31,000, it's possible that people will start itemizing again. A state and local tax, for instance, if you have a $15,000 or $20,000 real estate tax bill, uh, maybe you have a second home with $10,000 of real estate taxes, and you're paying state income tax of $15,000. That gets you above 40. So you're going to be limited to 40. Uh, so the 40,000 alone is enough to get you into itemizing your deductions.
Yeah, I mean, if you just think about it,
Mm.
average interest rates today between 6 and 7%, let's just say 6% for giggles, and you take a $600,000 mortgage, that's 36,000. Now you add the personal income tax and the real estate tax, you
Mhm.
could easily be at 70 or $80,000 of deductibility.
Right.
And now that person who might not have deducted in 2024, in 2025, 2026, they might well deduct. Now, what you said when we were preparing for this is there's an important caveat about income deduction related to the SALT. So please explain that.
Okay, so the our higher income taxpayers, there's a cliff pretty much. A cliff means you get your deduction up to a certain point. When you reach that total income level, you don't get deductions. It eliminates it. There's a phase out or a cliff. In mortgage interest, or state and local taxes, so not mortgage interest, state and local taxes, real estate taxes, income taxes. When your total income reaches $500,000, the $40,000 SALT tax deduction reduces back to 10. You don't eliminate it entirely, but you'll be back to $10,000.
And so
So,
for those guys, it hurts because they probably are paying a lot of state taxes and they may have a more expensive home, but that them's the breaks. Let's
right.
move on, if you will, to charitable deductions. What do we need to know?
Okay, so charitable deductions during COVID, for a couple of years of COVID, there was an above the line deduction. Uh, when I say above the line, before itemized deductions for a minimal amount of cash contributions. This is for those people who did not itemize. So you didn't have your SALT deduction was limited. You had a small mortgage and some charity, and you didn't get above the $30,000 standard deduction. So the government allowed us to deduct a certain amount of cash contributions, $300 and $600 in two different years. Um, that has been brought back. So if you're not itemizing, a single taxpayer can deduct $1,000 of charitable donations. Has to be cash, cannot be clothing or non-cash furniture,
By
things.
cash, you mean cash, checks, credit cards, but not
Cash,
not
cash and
not
checks,
donations in kind.
right, to public charities. So if you have a private foundation, does not qualify. But if you have a public charity, Salvation Army, uh, church, with a receipt properly documented, you can deduct $1,000 if you're single, $2,000 as an individual, as a married taxpayer. Now, that's pretty much with documentation. You're taking your standard deduction, so you're allowed that as an additional deduction. If you're itemizing, charitable donations are still deductible, non-cash and cash. There is a threshold similar to smaller than the medical expense one, but so medical expenses, you have to be above 7.5% of your total income in order to start accumulating tax deductible medical expenses. In the charitable donations, there's another floor. So you have to be above 0.5% of your income. So uh, if you're whatever charity it is, if it's $100,000, 1% would be, what is it, $1,000? So you're going to deduct $500.
Okay.
I think I got the math right.
But of course, Mark, if you decided to donate a wing to a hospital and it was $1 million deduction, a contribution, that would all be deductible.
Well, it would be as long as your income is high enough, because you
Right.
cannot deduct more than 60% of your income.
Okay. So
So
let's
that
keep
and
on,
that item
yeah,
will be carried forward.
let's keep on going. And, you know, um, I work from home and can I deduct my home office?
Well, if you're yes and no. So home office fell into what was called miscellaneous itemized deductions, and a lot of that was union dues, tax preparation, um, some other like periodicals, business newspapers, and things. All that was accumulated, and it was put into this category called miscellaneous itemized deductions. And back in 2017, that category was temporarily suspended, no deduction. So moving expenses was not moving, home office expenses was part of that. And so that miscellaneous deduction temporarily suspended has been made permanent. So that's no longer going to be deductible. If you're filing a small business as a Schedule C taxpayer, Schedule C would be working from home and filing a business, legitimate business, unincorporated, you can deduct a home office because it gets it out of the miscellaneous itemized deduction. For instance, if you were an employee and you had a home office for basically your own convenience, that fell into the miscellaneous category. Now, miscellaneous is gone. If you have a home office because you're in business filing a Schedule C, you still can deduct that home office expense.
Right. Moving. That's a big one for people in my business because our clients are often moving from one location to another. There used to be a rule about that, right? There used to be if you moved 100 miles or more, you could deduct it. What's going on today?
Right. It was like if you moved X number of miles from your old residence and you moved X number of miles, if your employer was more than X number of miles from your old residence and it's less than this from your new, that was again, that was a deduction, and many times employers reimbursed you for that. So it's added to your W-2, and then you got to deduct that on, if you itemized, you got to deduct that and offset. That was eliminated, except for armed forces, temporarily in the first tax bill, 2017. In this tax bill, the One Big Beautiful Act bill, that moving expense deduction is permanently excluded. You can't deduct it anymore. And again, that's except for armed forces, certain situations with the armed forces. So that's gone.
Right. So now tell me general provisions, standard deductions, casualty losses. Tell me a little bit more about that stuff.
Okay, so casualty loss is a big one. Casualty losses, personal casualty losses. If let's say you had uh, something happen at the home,
Storm damage.
storm damage, tree fell down, etc. Personal casualties, if it was not a federally declared disaster area, those personal casualties were eliminated. Used to be that you could submit it to insurance and then deduct 10% of the claim and throw that on as an itemized deduction. So that was eliminated, and that is gone now permanently. You can't do that. You can't get the deduction. If it's a federally declared disaster area, that's different. There is a push to get a state declared disaster area because federal disaster areas sometimes lag behind states. So, right, a lot of times governor will elect to declare something a federal state disaster area, and then the government comes in a couple of weeks later and says, yeah, this is bigger than was originally thought, and so we're going to declare that as a federal disaster area. Once it's a federal disaster area, then it qualifies for casualty loss relief. And usually you can amend a return. The IRS issues guidelines as far as what you can do, amend a back return or carry the loss forward. But it's only federal disaster areas.
And then the big gimme in my mind, I guess there's for certain people, there's the tip provision. I don't think we should go there, but the big gimme here was the per child tax credit that's been introduced.
Right. So the non-refundable piece is going to be $2,200 a child. So that's big for a lot of people.
And that's a credit, not a deduction. You want to explain that quickly because some people
Yes.
may not
Right.
understand.
So dependency deductions used to be able to get $1,000 or $2,000 per child as a deduction, in addition to your standard deduction. Those personal exemptions, remember, you used to get $1,000 for yourself. New Jersey allows you to take 1,000 for yourself, 1,000 for your spouse, if you're over 65, if you have a child or child in college. So those deductions are deductions against income. Back in 2017, those dependency exemptions were eliminated. They're still eliminated. So you don't get a deduction, but you get a credit. So after you calculate your tax, if your so a credit is always better. It goes against the tax. A deduction goes against your income,
Hmm.
reducing your income. But there is no deduction anymore. So a credit is all we have. That credit can reduce, it's a non-refundable credit, which means it can reduce your tax to zero, but you can't reduce it to below zero.
Hmm.
But still, most people who are going to take advantage of these are people who are young families who have income and are paying taxes and now have that ability to get reduce their tax bill a little bit more.
And then, of course, you mentioned it in passing, but let's just circle back to it. The standard deduction is really a major deal for a lot of people because married couple can deduct $31,000 as a standard deduction, which, as you said, means that for many, many people, they won't itemize.
Correct. So exactly. So let's say you have couple of people making a couple each having a nice life, suburban America, paying $15,000 in real estate taxes. They're going to have $10,000 tax bill for income taxes. So you're 25. You're going to be able to deduct that 25. And let's say they only have a $100,000 mortgage. Maybe it's an old mortgage, 4 or 5%. They're not, and charity, they give some money, but not really enough to make a difference. It's enough, it's a lot for them, but not enough to get them significantly above 30,000. They'll get their 30, no medical expenses, no casualty loss, really those two items don't get you above the 31, and that 31 is going to be adjusted for inflation going forward. They'll be able to deduct $2,000 of their charitable outside of itemizing, and they really have a simplified tax return. They get their child care credit. That could be complicated. You had said you didn't want to touch on tips or overtime. That could mean a lot for some people, and not so much for the general public, right? But the and it's going to be significantly harder on employers for this year. But putting that aside for now, standard deduction, simplified charitable deduction. Um, if they're over 65, they'll get this exemption for Social Security if they're collecting Social Security. Um, and pretty much a simplified tax situation. May not be so much simplified for state taxes. New York or New Jersey, many times the states are not recognizing these federal provisions. But so you may still want to itemize for state purposes if it's allowed. New York, it's allowed. New Jersey, you get your real estate taxes, but no mortgage interest deduction.
Right.
So it is simplified. Um, the I don't know if you want to just touch briefly on tax, on Social Security, right? We could do that.
Oh, that'd be great.
So Social Security, if you're collecting Social Security, you're over 65. The one of the promises, right, on the campaign trail was no tax on Social Security. Well, we still have a tax on Social Security. What we have is an exemption. We have an additional exemption that's allowed for people over 65, provided your total income is under $150,000. So if you're retired and let's say you're collecting $30,000 in Social Security, husband, wife collecting $30,000 in Social Security, and you have investments. If you control your capital gains, again, the market, it's unpredictable sometimes, right? You could have mutual funds that are throwing off capital gains late in the year. You're not going to know where you're going to fall. But this additional exemption for Social Security is effective for this year. So if you are close to $150,000, whether you have a job, maybe you're thinking about pulling money out of your IRA, and you don't have to, but you're thinking about doing it, or if you can control your capital gains, you want to make sure you're under 150.
Mm-hmm.
Over 150, no extra deduction. So you have to be under the 150 in order to get those extra exemptions for Social Security. Now, it's not limited to the tax on Social Security. This extra exemption offsets all income. So it is a real win for retired people on Social Security earning less than $150,000. Drawback, this provision goes out the window after 2028. Okay, why 2028? Well, President Trump is out of office. So a lot of things there are political backdrops to a lot of tax rules.
Mm-hmm.
Okay, so some of these provisions are permanent. Some of these provisions are going to be temporary for the current presidential term.
Okay.
That's the same with tax on tips and tax on overtime. That was a campaign promise. Short-sightedly, this campaign promise is only going to be good for this campaign, right? So President Trump promised it. For better or worse, I mean, after he's out of office, this goes away.
Okay. Let's just do one more thing about individuals, and let's do a quick pivot to corporations. Where the estate tax exemption is critical for some families, especially families with real estate. How did we fare on that?
Pretty good. There was a fear that this at the expiration, 2025 was the year that the old tax bill was going to expire, and there was a fear that everything was going to go back to the way it was, which would have meant about a $5 million exemption, estate exemption. So and portability was big as well, because there was portability, which meant that if one spouse didn't use their share of the exemption upon that spouse's death, the next spouse could make an election to utilize that. So right now we have a $15 million individual estate exemption, $30 million for a couple with portability, which means one spouse doesn't use that 15, the next spouse can use it as well upon that second death. And that's going to be indexed for inflation. So that's a big win. The individual gifting for 2025 is a $19,000 gift to individuals. So our clients who are so inclined to make gifts to reduce their estate, $19,000 a person. Husband and wife can give 38,000. They have multiple children. That's compounded. Doesn't have to be your own child. They can, give it to.
You can give my kids anytime you want. You can give it to me anytime you want.
Gift to my children, my grandchildren. If anybody's interested, I'll would gladly tell you how wonderful they are, and they deserve your gift. But so those gifts are available, and for our higher income people, taxpayers, it makes a difference. The thinking about the 529 plans, right? Now, this is not an investment seminar, but thinking about a 529 plan, you can front load a 529 plan for education 5 years. So 19,000, 5 years is $95,000. And if you have again, I have 2 grandchildren, so if anybody's interested, we could do that. It's the idea is that these items can be front loaded, the 529 plans. And so the investment options, there are investment options in this bill as well. And again, that's not really the focus on this seminar, but they do exist. There are other options as well and you wanted to pivot a little bit to business, uh, in the first tax bill, there was the introduction of what's called qualified business income, QBI. Big, big discussion. What was going to happen after 2025? Because this bill, this QBI, was only around until 2025. It's the 10-year tax bill, and it was going to expire. It's now made permanent. Same terms. QBI was intended to uh, to to afford a individual who was owner of a S corporation or a partnership, a pass-through entity, the ability to kind of get on the same tax footing as a corporation. In the first tax bill, the corporate tax rates were reduced to 21%. And the first tax bill, that 21% was permanent. There was not a there was no, retroactive or perspective going back to the graduated corporate tax rate. So corporate tax rates are 21%. Now there's a lot of talk every year about Congress increasing that and such, but right now we're still with 21%. The idea was the individual rates, if we could somehow, if it's a business that not a corporation, but it's a pass-through entity, somehow get that income at 21%. So if you're getting let's say somebody who's in a 35% bracket and they have income from a corporation, from a pass-through entity is going to be taxed at 35%, we'll give them a calculated QBI deduction to the extent of 20%.
So let's do some real numbers. Let's say you have somebody who's making $100,000 on their business. That means on the bottom line of their business, they calculate all their income, they calculate all their expenses. Bottom line of the business, they have $100,000 profit.
Mhm.
What is the QBI?
It would be 20% of that $100,000. And there are some limitations. There are some limitations over total income, and also for the real estate group, there's other limitations that kind of get you the ability, because sometimes you don't have income with real estate, but you have assets. So there are limitations there.
Mm-hmm.
But if that $100,000 is going to be subject to 35% tax, be paying effectively easy numbers, right? It's $35,000. If you get a 20% deduction, you're really paying 35% on 80,000. Okay, so that's getting you closer to what a 21% rate is on that income. That not intended to reduce the rate on all your income, but just to kind of get those pass-through entities for small business, S corporations and partnerships on the same tax rate schedule as a corporation.
Okay.
So that was extended now, and that's permanent.
Okay. And
Going
then let's just deal with I guess we've got some bonus depreciation, the Inflation Reduction Act. But let's just do one other thing that I think is critical for real estate investors. And I just wanted to focus on this, and we'll end with this. And that is the 1031 exchanges. Can you spend a little bit of time explaining a 1031 exchange, and then tell us how this bill affects it or doesn't?
Well, 1031 exchange hasn't really changed much at all. Okay, so 1031 exchange allows a bit if it has to be business property. Okay, so you have to use a third party intermediary. You have to identify the property. You have a certain amount of time before and after to complete the transaction. So nothing there has really changed.
So let's explain it. Let's just get into the weeds for a minute. I have a property. I wish I had a property that I bought for $1 million and now is worth $5 million. But let's just imagine that scenario. I had an office building. I bought it for $1 million. I want to sell it for $5 million. And normally I would have a $4 million taxable gain. And that could be fairly painful if you had to pay all the taxes on that. What do I do?
Well, if you could find one or multiple properties where you can basically exchange, right? You're giving up your investment and you're identifying something else to purchase. Uh, you may or may not have debt on there, but the debt is going to be important. You're going to have to you have to replace like kind debt. You can't buy a personal beach house with your factory. But if you're identifying business property and business property, you have to reinvest the proceeds. If you're not reinvesting the entire proceeds, or you're not replacing the exact amount, at least the same amount of the debt, you basically have improved your individual position, and you'll pay tax on that. So if you're not going to replace $1 million of debt with $1 million of debt, effectively you have what's called boot, and you'll pay tax on that because effectively your financial position has been improved. You really took something out of the property.
But the net effect is, I don't eliminate the tax because at some point you're going to have to pay the piper. But
Maybe.
I could kick it down the road.
Right. So many people are kicking it down the road. Let's say it's keeping it in the family, right? And the intent is that this was always going to be a legacy family property. Okay. No, we've done a 1031 exchange, and now it doesn't have that same,
Doesn't have my name on the building.
doesn't have your name on the building anymore. It's no longer your factory because you sold your business, but it's legacy money, legacy property. And we have a $30 million, $15 million individual, right? Estate exemption. So perhaps there will not be a tax on this. Let's say you have a $5 million gain, and maybe there are other investments, and most people are going to get to $15 million. If you're a business, if you have a $5 million building, and maybe it's a $5 million IRA or retirement plan, very easily get there, right? Personal residence, if you have a $5 million business property, you probably have $1 million residence at least. You can get to 15 million. Okay. Now we get that far above 15 million, maybe, but it's going to exempt the majority of people. This is not an elimination of an estate tax for the Rockefellers and the Gateses and the Musks and such, right? The idea is for the majority of people, our clients, right? A $15 million estate is easy to get to. Life insurance, if the estate is a beneficiary, again, that's where you have to really look at your planning. If you have a life insurance policy where your estate is a beneficiary, that's part of your $15 million exemption. So you have to get that life insurance out somehow. But the kicking the gain down the road, you're correct. That's a good example. And if you can get further enough down the road, you may not pay tax on it.
Right. Hey, Mark, you've been so generous with your time. I would ask you to send us your contact information. We'll paste it below. As I said, we've been joined by Mark Jurewicz, who is a master accountant. We've known each other for a bunch of years, and great guy. Truly a pillar of the community. I hate to use that word, but it's the best word I can think of. Great host, by the way. You want to go to a barbecue at Mark's house, and
we'll set something up again for you.
And so this has been a great education experience for me, and I'm sure for our listeners. And thank you so much for joining us, and thank you, Sonia, as well.
Glad to be here.